All right, let's dive into the two dominant accounting languages of the entire financial world, US GAAP and IFRS. You can think of them as two different rule books for the exact same game. And as you're about to see, the rules you pick can completely change the final score.
So, picture this. You're an analyst, right? And you're looking at two financial reports for the exact same company, covering the exact same time period. But something's weird. The profits don't line up, the assets are valued differently. It honestly feels like you're looking at two totally different companies. So what on earth is going on here?
Well, this isn't a mistake, and it's not some kind of accounting magic trick. It's simply the result of companies speaking two different financial languages. And depending on which language they're using, well, you as an investor could draw completely different conclusions about their performance.
So what are these two competing rulebooks that create this kind of split-screen reality in global finance?
Okay, on one side you've got US GAAP. That stands for Generally Accepted Accounting Principles. This is overseen by the FASB, and it's pretty much the standard in the United States. Then, on the other side, you have IFRS, or International Financial Reporting Standards, which is used by, well, pretty much the rest of the world, over 140 countries.
So what this creates is this fundamental divide in how global finance works. You basically got the US on one island and most of the rest of the world on another, and they're each using their own set of accounting maps to navigate.
But you know, the key thing here isn't just about who uses which standard. The real story, the interesting part, is the core philosophy behind each one. It's a fundamental disagreement on the best way to represent financial truth.
And this whole thing really boils down to a classic conflict of ideas. Is it better to follow a set of really specific, detailed rules, or is it better to apply broad, overarching principles?
And this right here is the absolute core of the distinction. US GAAP is what we call rules-based. Think of it like a massive, super detailed cookbook with precise instructions for every possible scenario. It's designed so that everyone's final dish comes out looking exactly the same. IFRS, on the other hand, is principles-based. This is more like giving a skilled chef a list of high-quality ingredients and a goal, say, make a fantastic pasta dish, and then trusting their professional judgment to create the best result.
But listen, this isn't just some academic debate for accountants. This philosophical difference has a huge, tangible impact on the actual numbers that we, as investors and analysts, look at every single day. Let's get into a couple of really key examples.
Okay, first up, inventory. US GAAP allows a method called LIFO. That's last in, first out. It basically assumes the last things you bought are the first things you sold. Now, when prices are rising, this method gives you a higher cost of goods sold, which means, you guessed it, lower reported profits. But IFRS, it's straight up forbids LIFO. So this one difference alone can make an IFRS company's profits look a whole lot better than an identical US company's.
Lease accounting is another huge one. With IFRS, pretty much all major leases are treated the same way, which often results in higher expenses in the early years of the lease and lower ones later on. But US GAAP has this special category for operating leases that lets companies report a smooth, steady expense over the entire lease. So it's the same lease, but you get a completely different pattern of reported profits year to year.
And as the finance storyteller points out, sometimes the differences are really just about presentation, what you call something or where you decide to put it on a statement. But as we've just seen, they often go way deeper and can fundamentally change the bottom line and how profitable a company appears to be.
So we get it, they're different. But why does this actually matter to you when you're looking at a company's financial reports?
Here's the bottom line. You simply cannot put a US GAAP report next to an IFRS report and make a fair apples-to-apples comparison. It just doesn't work. Key financial ratios, everything from profitability to leverage, they're all going to be skewed. To do it right, you have to dig into the footnotes of the financial statements and understand the specific accounting choices that management made. Trust me, that's where the real story is.
Which leaves us with a final, really important thought. The next time you see a big headline profit number or a company's total assets, don't just ask yourself, what is that number? The much more powerful question might just be, how exactly did they measure it?
And as always, please remember this explainer is for informational purposes only. This is not financial advice.